Welcome. In this video, we're going to be talking about index fund investing, demystifying key concepts. There are so many terms that we don't understand, and it can make it overwhelming. So I'm going to take some of the more important ones to know when you're looking at what you should invest in and breaking down what they mean, giving you examples to understand better what you're looking at so you can make an informed decision on how to reach your financial freedom. The first concept we're going to look at is index holdings. It's what the index holds. Think of it like a fruit basket. The basket holds the fruit. And in an index, there's a variety of stocks. Just like in a good fruit basket, there's all sorts of variety of the different types of fruit to give you a better overall flavor of what's in there. So we're looking at holdings are what's in the index fund. And the diversity is what we're looking for. Now, let's talk about tracking errors. We talked in another video about how indexes are set up by basic rules. Well, those rules, we want to see how they're tracking and whether there's error. Think of it like a mirror. A highly accurate mirror gives you a good reflection of what you're seeing. A low tracking error, below 2% is what we're shooting for, reflects that the index is following the plan that it set out to. Means it was prepared well and it is following that index. A high tracking error means that it's not following as planned. Doesn't necessarily mean that it's bad, it just may not be going as accurately as they expected. You want to watch those tracking errors. It's like looking in an old mirror that is not accurate. You see a distorted view of what it should look like. High tracking errors are like looking in a distorted mirror. You're not seeing what it was intended to show. We want low tracking errors. Expense ratios are something to keep an eye on. They can erode your compounding ability as funds are being extracted to pay for the management of that fund. I have a fund I like, one of my favorites, with an expense ratio of 0.04. That means for every $10,000, I'm only being charged $4. Basically indexed, it's running itself. Those are just administrative costs. The average mutual fund, you're looking at 0.5 to 1, and that's $50 to $100 for every $10,000. Over the course of 30 or 40 years, that $50 or $100 is being eaten and eroding your compounding ability. It is a huge amount, and we'll look at that in another video on the amount you lose from high expense ratios. But just know that you need to be looking at the expense ratio to make sure you're not overpaying. Like I said in another video, SWPPX and S&P 500 index has a 0.02. That means $2 for every $10,000 invested. That's not going to impact your future growth and compounding. Think of it like a well-maintained highway. They collect tolls to keep it from being so bumpy. The diversification that you're getting is that toll smoothing out the road. But too much expense can be overwhelming. If you take trips through certain places and you go to tolls and you're spending $20, $30, it kind of ruins the fact the road may be a little bit smoother. There has to be a balance. Look for low expense ratios that provide quality growth. The dividend yield. That is another important concept to understand about index funds. Think of it like a tree producing fruit. Different trees produce different amounts of fruit. Well, stocks, the owners get a portion of the profit each year. So the company says, hey, we're going to pay out this amount to our stockholders. So for example, if a stock is worth $100 and at the end of the year, they declare they're going to pay you $3.50. That is your dividend, $3.50. Now that may be split over monthly, it may be split quarterly, and a few companies actually pay it annually. In an index fund, you have many companies doing that, and so it averages out. So how do you figure out a dividend yield? In that example, a $3.50 dividend divided by a $100 price gives you a 3.5% dividend yield. Now, if that stock goes up to $150, Your dividend is still $3.50, but because you're dividing $3.50 by $150, now your dividend yield is 2.3. But if that stock goes down to $50, you still get the $3.50 dividend, but now your dividend yield is 7%. So don't get too excited when you see high dividend yields, because it may indicate a stock is crashing. Not necessarily, it may just be in a dip. Buying in the dip is the best time because you're capitalizing upon the lower price, the higher dividend. Take advantage of those dividend yields, but keep an eye on them. If they're going too high, it could mean trouble for that stock. The good thing, you're in an index fund, they're averaged out, and if one's dying, another's coming to life. The next concept is market capitalization. Think of it like a community. You have your large homes, the mansions, you have your mid-size home, and then you have your smaller cozy cabins. That's just like the stock market. The large capitalization are the large mansions, the big companies. Then you have your mid-size or your mid-cap companies, and then your small-cap companies. These represent the community as a whole. So when you're looking at these index funds, are they made up of all large cap? Are they made up of all small caps? Or is it a blend of both? Now let's look at rebalancing. Rebalancing is when the fund looks at where it's at versus where it's supposed to be. If something is too heavy weighted, holding too many stock of that particular item, of that particular company, they need to rebalance to keep it within the rules that they set when they established the fund. So rebalancing is something that they often do quarterly, and then annually they may remove and add funds as needed. So rebalancing is like, think of a garden that just needs to be weeded and trimmed to maintain the desired height of the different plants for the aesthetic that you're looking for. When you planted it, you planned that you'd have these pretty flowers in the front, accented by the larger ones in the back. The index fund is very similar. You're looking at the various index, at the various stock, and you're seeing, are they out of balance to what the rule established them for? Then annually, sometimes they just go in and they totally uproot a particular plant. They get rid of it. It's not doing what it was supposed to do. Maybe it got diseased. Maybe it had a CEO change. Something happened. It's time to uproot that, and they plant a new plant, a new stock in that index to take its place. That's all rebalancing is. Sector allocation. Sector allocation is basically thinking of like a puzzle. There's various pieces making up the entire puzzle. Different sectors may have more versus the other sector. Just like a puzzle may have more of one color than another. But when you put it all together, it makes the index, just like a puzzle. Having pieces missing, you need the entire puzzle to see the picture of what it was intended to do or intended to be. Index methodology. Basically, that's the rules the index was set up on. How is this index going to be weighted? How is it going to be reconstituted? What stocks, what market, what sector? Those are all methodology. Think of it like baking a cake. We can bake the same cake using different ingredients. Maybe I use more flour. Maybe you use more sugar. Whatever it is, the outcome is still the same. We still get the cake. They just have different taste. That's what an index fund is. Different markets, different sectors with the same goal. They may be very similar, but weighted slightly different. Those are just small pieces of that puzzle that we talked about a moment ago. Baking a cake, you have to measure out where the ingredients go, what ingredients are included. But you can make a chocolate cake in 100 different ways. There are lots of index funds. Some of them are very similar. Some of them have slight different weightings, but they're still very similar. It'd still be considered a chocolate cake. That is index methodology. Historic performance is a key thing to look at. Just because a stock's doing really well today doesn't mean it's going to do great in 10 years. So when you're looking at a stock or an index fund, you want to look at its historic performance. Now that doesn't guarantee that's what it's going to be in the future, but because it's shown stability and accuracy to the index and the rules and the methodology, it gives us a good hope and indication that it will continue to do well. Think of it like a truck or a car's track record. There are certain trucks and cars in the market. They come out, they're the new flashy thing. Everybody wants one, but they haven't been proven. They don't show reliability. They end up with 100 recalls. All sorts of dangerous things can happen. We don't know. The point is, you don't know the track record. Then there's other cars and models that we know they've been around for years, and they have a track record of proven reliability where you're going to get 150, 200,000 miles out of it if you want, that you're not going to have all sorts of maintenance. An index fund is very much like that. You want to look at its performance. I recommend looking at 5-year at minimum, but better 10-year performance. How has it performed over a course of 10 years? And if it has been longer than that, even better. Since inception, when the fund was started. There are funds that are out there that are 30, 40, 50 years old that have a proven track record. Look at the historical performance as a marker of measuring what it should and could do in the future. Again, there's no guarantee. The last concept we'll talk about is the beta. Beta is just the fancy stock market term for volatility. So we've talked about the S&P 500 index. That is an index that follows the S&P 500, the top 500 companies in the S&P, the top 500 companies in valuation, making up about 80% of the value of the entire stock market. That is the benchmark. So 1 is the benchmark geared off the S&P 500. Now, if you have a beta that is higher than 1, that means that the index is moving more than the S&P 500. So if the index goes down, it goes down more than the S&P 500 usually does. And if it goes up higher than the S&P 500 does. That's what we call volatility. High beta means high volatility. Over 1 is a higher volatility. Under 1 means that it moves less. So when the S&P 500 is going down further, the index that is a lower beta goes down less than the S&P 500 normally would. Think of it like the roller coasters. You go to some and there's lots of ups and downs. Those would be the high beta, high volatility, those that love the thrill. And then you have those that just have the little smooth, little bit of movement here and there. Makes you feel like you're excited, but there's not too much. You don't have to worry. It's nice and easy ride. That is a lower beta. Making your decision on how well you can handle that volatility is vital, because if you're going to panic every time the stock market goes down or get overly excited every time it goes up, you're going to be in for a long ride. The road to financial freedom. I love Dave Ramsey's quote where he says the only person who gets hurt on a roller coaster is the person who jumps off. You're on the stock market, it's going to go up long term, but don't jump off just because you're going down a big hill right. That's why index funds are great, because they're diversified and they can handle those ups and downs much better. Thank you for joining me today as we unfolded some of the key terms and concepts of index funds. Better understanding what these terms mean helps when we're looking and researching and trying to determine what we want to invest in. A lot of these terms can go over our heads and confuse us and cause great panic. If you're still not sure, rewind and watch some of these points again. Look at an index and find these things and start practicing. Look at an index fund. Pull it up on Yahoo Finance and look at the summary. Find the expense ratio. Find the beta. Go over to the performance tab and see what is the historical performance over the last 3 years, 5 years, 10 years. Get an understanding and start looking at different indexes and how they differ in these concepts we just spoke about. You'll better understand. You'll go into investing with greater confidence and you will not panic when things change. Again, thanks for joining us at Simply Money. We're excited to continue to offer you insights, education, knowledge to better help you and equip you on your journey to financial freedom.